Welcome to another session of the My Solo 401k Financial YouTube and LinkedIn webinar series. We're continuing our deep dive contribution discussions. We'll be getting started momentarily. We're just waiting for the viewers to join and confirming that the audio is good. All right, so it looks like the audio is good. We're going to get started here in a second with some housekeeping, then we'll dive into the content. We would ask you to please like and subscribe this video. If you're watching here live and you're on the YouTube channel, you can post comments and questions in the comments in the chat, YouTube chat feature. If you're watching as a recording, you can post comments in the YouTube video post as a recording will be posted on YouTube. You can also go to our community where we host webinars every day of the week, live webinars where you can ask questions, etc. You can also post questions in our forums 24/7. You can see what other people are posting. You can post your own question. So you can see that next week we'll be continuing our deep dive contribution discussions. Next week we'll be focusing on businesses that are taxed as sole proprietors, 1099 independent contractors, or single member LLCs. So please continue the conversation in our community. You can access it. It's free to join. All are welcome. You can access it at mysolo401k.net/mycommunity. So we'll get started with our housekeeping. The presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. Today's focus is businesses or our businesses, self-employed businesses that are taxed as partnerships or multi-member LLCs taxed as partnerships, filing a Form 1065 with the self-employment income reported on a K-1. We also want to focus today on Mega Backdoor Roth Solo 401k contributions, because that's one of the most popular reasons that clients are setting accounts up with us, is to take advantage of that feature that our plan offers. At a high level, the benefits of a Mega Backdoor Roth Solo 401k is that it allows someone to contribute as much as $58,000 or even $64,500 for someone who's 50 or older for 2021 to a Roth Solo 401k. And for 2022, that contribution limit increased to $61,000 or $67,500 if you're 50 or older. The benefits of having money in a Roth Solo 401k is the potential for tax-free growth. So the first step is to find a Mega Backdoor Roth Solo 401k provider. Of course, you have to qualify, which means that you're self-employed with no full-time W-2 employees working for any business owned by you or a spouse, if any. Assuming that you qualify, you would then need to find a 401k provider, a solo 401k provider. And if your goal is to make Mega Backdoor Roth contributions, you want to look for a provider that offers a plan that allows for voluntary after-tax contributions and in-service distributions, because technically that's how you make a Mega Backdoor Roth contribution. You, of course, also want to look for a provider that assists with establishing the required sub-accounts, because you'll need separate accounts for pre-tax, Roth, and voluntary after-tax funds. And lastly, you want to look for a provider that provides the ongoing compliance support that specifically applies to people that are making Mega Backdoor Roth Solo 401k contributions. For example, look for a provider that will handle the 1099-R. We, of course, offer a plan that allows for the Mega Backdoor Roth contribution. We assist with establishing the required sub-accounts, and we handle the required 1099-R as part of our service for no additional charge. So now we're going to turn to how much you can contribute to a plan. We'll go through some scenarios to see how it works. And we'll also talk about the mechanics of making contributions as well as making Mega Backdoor Roth contributions. So the starting point when you're determining how much you can contribute is noting that your ability to contribute to the plan is based on certain factors. Number one, it's based on your income, specifically your self-employment income, because you cannot save more than you earn. It's based on your age, because once you're 50 or older, you can make what's called a catch-up contribution. So you can make higher contribution amounts. It also depends on whether you participate in another retirement plan, like a 401k plan through your day job. And then finally, it depends on the type of contribution that you're looking to make. Because with a solo 401k, you are both the employee as well as the employer. So you can make both employee as well as employer contributions, but the limits depend and are different for each type. It also depends on whether you're looking to make pre-tax, Roth, and or voluntary after-tax contributions. So when we'll go through these scenarios that we're going to present on the following slides, that'll really illustrate how it all works. Before we get to the scenarios, though, we want to break down each of the elements and look at the limits. So the first element is the self-employment income. So for a person that has a self-employed business taxed as a partnership, your ability to make solo 401k contributions is based off of your earned self-employment income, which would be reported on line 14 of your K-1 after reducing 1/2 of the self-employment tax. So you have to first run that pre-calculation, line 14 of the K-1 less 1/2 of the self-employment tax. Keep in mind that you cannot consider W-2 wages from other sources like a day job. You also can't consider investment income, because the whole purpose of a solo 401k is for a self-employed person to save their earned income, not their investment income for retirement. So again, step one, run that pre-calculation. So you'll use line 14 K1 of the code A of the schedule K1, which is your net income figure, less 1/2 of the self-employment tax. We do have a calculator on our website that will run this calculation for you, and we'll take a closer look at that calculator in a later slide. Next, you want to consider the year that you want to make contributions for. So the contribution limit went up from 2021 to 2022. So the overall limit for 2021 is $58,000 or $64,500 if you're 50 or older. For 2022, the limit went up to $61,000 or $67,500 if you're 50 or older. Next, you want to consider and determine the type of contribution that you're looking to make. Are you looking to make an employee contribution or an employer contribution? Again, you can make both types. Employee contributions can be made as pre-tax, Roth, and or voluntary after-tax. If you're going to make a Roth or a voluntary after-tax contribution, the contribution needs to be deposited into a separate sub-account. And with a later slide, we'll illustrate how those multiple sub-account setup works. Employer contributions are always pre-tax contributions. And keep in mind that employer contributions are not impacted by contributions that you make to another plan. So the employee limit applies at the employee level. If the employee is participating in multiple plans, let's say you have a 401k plan through your daytime employer, and then you also have a solo 401k for your side business. If you max out the employee contributions to your day job plan, you can't make any more employee contributions, but you could still make employer contributions. And when we go through the contribution scenarios, we'll really illustrate and that point. Okay, so let's take a look at the limits. So first limit is the employee contribution limit. So employee contributions are also referred to as salary deferrals. And those could be made as a pre-tax contribution to reduce your taxable income to get a tax benefit now. So the limit is 100% dollar for dollar of your self-employment compensation. Remember, if your self-employed business is taxed as a partnership or a multi-member LLC taxed as a partnership, filing a 1065 for the business, your self-employment compensation is equal to line 14 of the K-1 less 1/2 of the self-employment tax. So you run that calculation and then you can contribute 100% of that amount dollar for dollar up to $19,500 for 2021 or $20,500 for 2022, plus an additional $6,500 for each year if you're 50 or older. Now, you do need to reduce how much you contribute to the plan by any contributions that you make to another plan, like the day job plan. The one exception to that is if that other plan is a 457 governmental plan. In that case, the contributions are not aggregated. Now, the employee contribution amount could also be contributed as a Roth contribution. So in that case, the money would have to go into a separate sub-account. So you could do all the employee contribution as a pre-tax contribution. You could do it all as a Roth contribution, or you could do a mixture, some of the amount you might make as a pre-tax, some as a Roth. Okay, next is employer contributions. Remember, employer contributions are always pre-tax contributions. There's no such thing as a Roth employer contribution. Employer contributions are also referred to as profit-sharing contributions. So the limit for someone whose self-employed business is taxed as a partnership or a multi-member LLC taxed as a partnership is 20% of your self-employment compensation. So again, you've got to run that pre-calculation. Line 14 of the K-1 less 1/2 of the self-employment tax. And our online calculator will run that calculation for you. Of that amount, you can contribute up to 20% as an employer contribution. Now, keep in mind that the sum of all the contributions that you make to the solo 401k, employee, employer, voluntary after tax, can't exceed the overall limit, which again for 2021 is $58,000, or for 2022 is $61,000, plus an additional $6,500 if you're 50 or older. Now, unlike the employee contributions where the limit applies at the employee level, which means that you've got to aggregate with the contributions that you make to another plan, like a day job plan, the employer contribution limit is not impacted by contributions made to another retirement plan, like the day job 401k plan, unless the other plan is a 403b. So if you have contributions that you make or that are made on your behalf to a 403b, you have to aggregate those contributions with contributions that you make to the solo 401k to ensure that the total contributions don't exceed the overall limit. Next, let's look at the voluntary after-tax contribution rules. So keep in mind, voluntary after-tax contributions are how someone makes a Mega Backdoor Roth contribution. Because as you'll see, the voluntary after-tax contribution limit is higher than the Roth limit. Remember, the Roth limit is really the employee limit. So $19,500 for 2021 or $20,500 for 2022, plus an additional $6,500 if you're 50 or older. The voluntary after-tax limit, though, is higher. It's the lesser of your self-employment compensation and the overall limit. So if your self-employment compensation is greater than the overall limit, then you can't exceed the overall limit. If it's less than the overall limit, then that's the most you can contribute because you can't save more than you earn. Remember, the self-employment compensation amount for someone whose business is taxed as a partnership is line 14 of the K-1 less 1/2 of the self-employment tax. So you can contribute dollar for dollar, though, 100% of your self-employment compensation up to the overall limit, which is $58,000 for 2021 or $61,000 for 2022. Now, you do need to reduce by any employee or employer contributions that you make to the solo 401k. This limit, unlike the employee limit, but like the employer limit, is not impacted by contributions made to another plan, like the day job 401k plan, unless the other plan's a 403b. Like the Roth contributions, though, voluntary after-tax contributions have to be deposited into a separate sub-account for each participant. This is how you might end up with 3 different sub-accounts: a pre-tax account, a Roth account, and then a third voluntary after-tax account. Now, I want to note that this limit doesn't go up if you're 50 or older. So it's still 58,000 for 2021 or 61,000 for 2022. But at the same time, you don't have to reduce how much you can contribute as a voluntary after-tax contribution by any catch-up contributions that you make to the solo 401k. So effectively, you can still get there and make those additional $6,500 contributions if you're 50 or older, but you make those catch-up contributions as an employee, not as a voluntary after-tax. And we'll see an example in one of the scenarios to really illustrate that point. So now we're going to turn to the scenarios. So the way that we're going to approach this is by setting up a baseline scenario and then tweaking each of the elements to illustrate how that impacts how much you can contribute to the plan. So our baseline scenario is a self-employed business taxed as a partnership, or a multi-member LLC taxed as a partnership, one participant making contributions to the plan who's under 50 years of age, who does not make contributions to another plan, whose goal is to first maximize the pre-tax contributions and then make any additional contributions as Roth and or voluntary after-tax solo 401k contributions. Now we're assuming that this person has $100,000 of self-employment compensation. Remember, self-employment compensation, when your business is taxed as a partnership, is line 14 of the K-1 less 1/2 of the self-employment tax. So this person would first make $19,500 as a pre-tax employee contribution for 2021, or $20,500 as a pre-tax employee contribution for 2022. This is because they can contribute 100% of their self-employment compensation dollar for dollar up to $19,500 for 2021 or $20,500 for 2022. Next, this person would make a $20,000 employer contribution. Now, employer contributions are always pre-tax contributions, and the limit, again, is 20% of the self-employment compensation. They would still have additional contributions that could be made as voluntary after-tax contributions. For 2021, they can make an additional $18,500 as a voluntary after-tax contribution. For 2022, they can make an additional $20,500 as a voluntary after-tax contribution. Remember, the limit for voluntary after-tax contributions is the lesser of the self-employment compensation, which we're assuming is $100,000, or the overall limit. So they can contribute 100% dollar for dollar up to that overall limit, but you have to reduce it by any employee contributions and as well as employer contributions. So that's how we end up with those $18,500 figure for 2021 and $20,500 amount for 2022. So now let's change the assumptions. Now let's assume the person has $50,000 of self-employment compensation. How does this impact how much can be contributed to the plan? So as we can see, it doesn't impact how much you can contribute as an employee contribution. It's the same amount. It does impact how much can be contributed as an employer contribution, because remember, the employer contribution limit is 20% of the self-employment compensation. So now it's 20% of a lower number. It's 20% of 50,000, which is equal to 10,000. It also impacts how much can be contributed as a voluntary after-tax contribution, because now remember that the voluntary after-tax contribution limit is the lesser of the self-employment compensation, or the overall limit. So here the self-employment compensation is lower than the overall limit. So it'd be 50,000 less the employee contribution, less the employer contribution, results in $20,500 that can be contributed for 2021 as a voluntary after-tax contribution, and $19,500 for 2022 that can be contributed as a voluntary after-tax contribution. And then this person would transfer the money from the voluntary after-tax sub-account over to a Roth Solo 401k or Roth IRA to complete that Mega Backdoor Roth Solo 401k process. So let's go back to the base, and now the person again is making 100,000, but this individual has maximized the employee contributions to their day job plan. So that means that this person cannot make any employee contributions to the solo, because this illustrates how that employee contribution limit applies at the employee level. Since the person already maximized contributions to their day job plan, they can't make any more employee contributions to the solo, but they can still make the employer contribution, the $20,000 pre-tax. And they can still make the voluntary after-tax, because both the employer contribution limit as well as the voluntary after-tax contribution limit is not impacted by contributions made to a day job 401k plan. So here this person would make 20% or $20,000 as a pre-tax contribution, and then they can do the difference up to the overall limit, $38,000 for 2021, $41,000 for 2022 as a voluntary after-tax contribution, and then transfer over to the Roth Solo 401k or Roth IRA. So if they transferred over to the Roth Solo 401k for 2021, they would have $20,000 in their pre-tax Solo 401k sub account and $38,000 in their Roth Solo 401k sub account. For 2022, they would have $20,000 in their pre-tax Solo 401k sub account and $41,000 in their Roth Solo 401k sub account. So let's go back to the base and change one of the assumptions. Now let's assume that the person's not interested in making pre-tax contributions. They're only interested in making Roth and/or voluntary after-tax contributions. So this person would make the employee contribution of $19,500 for 2021 or $20,500 for 2022, but instead of depositing it into their pre-tax Solo 401k sub account, they would make that contribution to their Roth Solo 401k sub account. This person would decline to make employer contributions because they're not interested in pre-tax contributions, and employer contributions are always made on a pre-tax basis. So that means they can make the difference up to the overall limit, since their self-employment compensation is greater than the overall limit, as a voluntary after-tax contribution. So that means they're making $38,500 as a voluntary after-tax contribution for 2021 and $40,500 as a voluntary after-tax Solo 401k contribution for 2022, and then move the money over to the Roth account. So at the end of the day, they have $58,000 in their Roth Solo 401k for 2021 and $61,000 in their Roth Solo 401k for 2022. So now let's go back to the base, but now let's assume that there's two participants. What changes, if anything? Well, nothing changes in terms of how much can be contributed. This contribution scenario illustrates how the ability to contribute to the plan when there's more than one participant. Let's say there's a husband and wife that are both working in the same self-employed business. They're both participating in the plan. They have the same fact pattern, right? Age, how much they make, etc. So each person would be able to contribute based on their scenario. Since they're both in the same scenario, they both can contribute the same amount. So now let's go back to the base and let's assume that the person is now 50 or older years of age. What changes, if anything? Well, nothing changes in terms of the amounts, other than the fact that now the person can make a $6,500 catch-up contribution. And that is made as an employee contribution. And since this person's goal is to first maximize pre-tax contributions, they would make that additional $6,500 as a pre-tax employee contribution. This scenario also illustrates how the voluntary after-tax contribution limit doesn't go up if you're 50 or older, but you also don't have to reduce how much you can contribute as a voluntary after-tax contribution by any catch-up contributions made to the plan. So you still get there in terms of being able to hit the $64,500 limit for 2021 or $67,500 limit for 2022. So now let's go back to the base and we're going to change the scenarios. Here now this person wants to only make Roth and or voluntary after tax, but they've maximized contributions to their day job plan. So that means they're not able to make any more employee contributions to the solo 401k. They're not interested in making employer contributions because those are always made as pre-tax contributions. And this person only wants to make Roth and or voluntary after-tax contributions. So that means that they make the entire contribution as a voluntary after-tax contribution, 100% of their self-employment compensation, dollar for dollar, up to $58,000 for 2021 or $61,000 for 2022. So now let's go back to the base. So again, same scenario in terms of only interested in making Roth and or voluntary after tax, but now this person is 50 or older years of age. Likewise, they've still maximized contributions to their day job plan. So what changes, if anything? Nothing, right? You still can't make employee. You still don't want to make employer. You can still maximize the contributions as an after tax, but again, the limit for voluntary after tax contributions doesn't go up if you're 50 or older. Thanks for the feedback. We appreciate it. If you do have comments, go ahead and post them up there, and then we'll go over them at the end of the presentation. So let's keep going with the scenarios. We got a few more, at least one more. So again, let's go back to the base, $100,000, only interested in Roth or voluntary after tax. They've maximized contributions to their day job plans, but here there's two participants. So what changes, if anything? Again, nothing. So again, we're just illustrating the point that the ability to contribute to the plan when you have more than one participant is based off of each person's scenario. So how much each person reports as self-employment compensation, each person's age, whether each person participates in another solo or another 401k plan, like a day job plan. So that does take us to the end of the scenarios. So now we're going to switch gears and talk about the mechanics. We're going to first highlight our online calculator. So if you go to our website, mysolo401k.net, there's a drop-down menu under Learn. If you click on Online Tools and click through, you'll get to our online calculator. So if your business is taxed as a partnership or multi-member LLC, you're going to select unincorporated sole proprietorship. You're going to enter your net income from line 14 of the K-1, and then the calculator will determine what 1/2 of the self-employment tax is. You'll enter your age, right? Because remember, it goes up if you're 50 or older, the limit goes up. Then you'll be able to view the report. You can print to keep a copy for your records. You will modify if you're making day job contributions. So the calculator doesn't contemplate someone who's making contributions to another plan. You'll also modify if you're looking to make after-tax contributions, because the calculator doesn't contemplate that situation. So now that you've figured out how much you can contribute and how much you want to contribute within those limits, it's time to make the contributions. So you'll make those contributions by check or wire into the applicable account and report the contributions. So let's dig a little deeper in terms of these mechanics. So how do I make the contributions? Again, you can make the contribution by check. In that case, make the check payable in the name of the plan and write annual contribution on the memo section of the check. You could also make the contribution by electronic deposit. You'll need to check with the financial institution that holds the solo 401k account to determine their process to receive electronic deposits from external accounts. Now, we do help a large number of our clients open accounts at brokerages like Fidelity, Schwab, TD Ameritrade. The general rule for the brokerages is that they won't accept electronic deposits from an external account where the name on the external account doesn't match the name on the account at the brokerage, i.e. the name on the external account is not in the name of the plan. The one exception to that is Fidelity. Fidelity does allow you to make electronic deposits from an external account where the name doesn't match. Now, the deposits are made into separate sub-accounts if you have multiple participants, like the husband and wife scenario we were alluding to earlier. Also, if you've got different types of funds, right? I mean, this is, if you're trying to make Mega Backdoor Roth, you might have pre-tax, Roth, and or voluntary after-tax contributions that you're making. So each of those need to be made into separate sub-accounts. As part of our onboarding process, we'll be asking you what type of contributions you're looking to make so we can prepare the paperwork to open the requisite number of accounts. You can make the contributions in one lump sum or a series of contributions. You can make the contributions from your personal account or your business account. Either is acceptable from a solo 401k perspective. Now, when is the deadline to make contributions? Well, it's clear based on IRS publication 560 that you can make all types of contributions by the business tax return deadline, including any timely filed extension, as long as the plan was set up by the end of the tax year. So this is different than the rules that do apply to a full-time employer plan, right? Where the employees have to make the contributions by the end of the year. It's different because you're self-employed, right? A lot of self-employed people don't exactly know how much they've made until after the end of the tax year. So the rules give you more time. Again, as long as the plan was set up, meaning that by the end of the year, you'll have until the business tax return deadline, including any timely filed extension, to make the contribution. And again, this is clear based on IRS publication 560, which is the landmark guidance from the IRS for self-employed retirement plans like a solo 401k. We've got an excerpt here, which is a chart that's on page 3 of that publication. So what does that mean, right? So for 2021, if your business is taxed as a partnership, you have until March 15th of 2022, or if you file a timely business tax return extension, September 15th of 2022. For plans that are established by the end of 2022, you'll lock in the ability to contribute all types, employee and employer, etc., anytime up until the business tax return deadline, including any timely filed extension in 2023. So that means March 15th, or if you file a timely extension, September 15th of 2023. How do I report the contributions? Well, that depends on what type of contribution you're referring to. So as we saw, there's different types of contributions, right? So if you're making a pre-tax employee contribution, that's going to be reported on line 15 of Schedule 1 of the 1040, as well as line 13 of your K-1 using code R. Roth employee contributions, voluntary after-tax contributions, the contribution is not reported. Now, we do note with voluntary after-tax contributions, which is how folks are making Mega Backdoor Roth contributions, the funds are then moving from that voluntary after-tax account over to the Roth Solo 401k or Roth IRA. So while the contribution, the deposit into the contribution account is not reported, the move from the after-tax to the Roth Solo or the Roth IRA is reported on a Form 1099-R. So in that fashion, those amounts are indirectly reported. Now, if you're talking about an employer contribution, that is also reportable on line 15 of the Schedule 1 of your 1040, as well as line 13 of your K-1 using code R. So again, one of the focuses today is Mega Backdoor Roth. So that's where you're making an after-tax contribution and then transferring over to either the Roth Solo 401k or Roth IRA. So that transfer can be made by check or by electronic transfer. Of course, you want to check with the financial institution providing the accounts to determine their procedure. It could be between bank or brokerage. Either is acceptable. So brokerages are one of the most popular options. So we have clients, again, at many different brokerages. So we want to highlight how it works at the different brokerages. So when you first sign up, we'll be asking you, where do you want to have your account at? So if you tell us you want to have it at Schwab, for example, we would prepare the paperwork to open up a free brokerage account at Schwab. So step one would be to open that brokerage account at Schwab for your voluntary after-tax contributions, make the contribution within the limits by the deadline, etc., and then convert either to the Roth Solo 401k brokerage account, or it could go to a Roth IRA, either at Schwab or a different institution. Then you need to let us know about the amount converted, because we need to capture information in order to prepare the required 1099-R. Again, the contribution is not reportable, but the conversion is reportable. So we have a form on our website where our clients are letting us know about those amounts converted. If you go to our website, mysolo401k.net, there's a forms link in the upper right. You just click on forms, scroll down. We have one form if you're moving to a Roth Solo 401k. We've got a second form if you're going to a Roth IRA. So that provides us the information and gets your plan in the queue so we can prepare the required 1099-R. Now, if you want to have your account at Fidelity, that's another very popular option. It would be a similar process. We'll prepare the paperwork, open the account at Fidelity for the voluntary after-tax contributions, make the contribution, convert either to the Roth Solo 401k brokerage account or to a Roth IRA, whether at Fidelity or a different institution, and then again, submit the form to give us the information so we can prepare the required 1099-R. TD is another popular option. It's going to be a very similar process. We're just going to prepare the paperwork to open up the account at TD, make the contribution, convert to Roth, report the conversion by submitting the online form. Now, a popular question, a common question is, well, should I convert to a Roth IRA or a Roth Solo 401k? And there's no black and white answer. There's different considerations, though, for each choice. So with the Roth Solo 401k, one of the most popular use cases for our plans is investing in alternative investments like real estate, like notes, like cryptocurrency. So our plan allows for those investments. So if you keep the money in the Roth Solo 401k, you can then invest in those investments with that potential for tax-free growth. Another popular use case is the ability to take a loan. So with our plan allows for a 401k loan where you can borrow up to 50% of the balance, not to exceed $50,000, and we prepare the required loan documents. So if you keep the money in the Solo 401k, by transferring to the Roth, you'll still be able to use that money to justify taking a loan and borrow that money. Now, Roth IRAs, they don't allow for loans. Just like any IRA, whether it's Roth or traditional, you can't take a loan from an IRA. Also, if you want to invest a Roth IRA into alternative investments with checkbook control, you would need to set up an LLC underneath that Roth IRA. With the Solo 401k, you'll have direct checkbook access for purposes of making those alternative investments. With the Roth IRA, those are not subject to required minimum distributions. So once you reach a certain age, 72, you do have to take distributions from your Solo 401k, including Roth Solo 401k. With the Roth IRA, you don't. Now, in practice, what a lot of people might do is, as they're approaching that required minimum distribution age, is just simply transfer the funds from the Roth Solo 401k over to a Roth IRA to zero out the account as of the end of the year, so there's no RMD, at least for the Roth Solo 401k funds. There's no deadline to convert, right? We talked about how there's a deadline to make the contribution, but then there's a subsequent transfer from the after-tax account to the Roth Solo 401k or Roth IRA. There's no deadline to convert that money. Also, the conversion is reportable, but it's reportable for the year of the conversion. So you might be making 2021 Solo 401k contributions now in 2022, right, by March 15th or September 15th of 2022 if you filed a timely extension, and then converting the money now in 2022. So the conversion is going to be reportable for 2022. So the 1099-R is not going to be issued until 2023. And that's perfectly fine and acceptable, right? So even though the money that was in there as a 2021 contribution, the actual conversion is not reportable until the year that it happens. What's reported on the 1099-R is the amount converted. So that's going to be the contribution and gains, if any. Likewise, that amount's going to flow through to your 1040. So the amount converted is going to be reported on line 5A, and gains, if any, are reported on line 5B. There very well may not be any, right, if you didn't invest the money while it was in that voluntary after-tax account. So that's on line 5A, and if applicable, on line 5B of your 1040. Again, you just need to submit that online form so we can capture the information that we need to be able to prepare that 1099-R, which we do as part of our service for no additional charge. So now we're going to look at some illustrations to illustrate how the accounts might be set up, and then we'll turn to the questions. Thank you so much for all the participation as we go through these slides. So with our first example, we've got one person who has 3 accounts. So they have one account in the name of their plan, XYZ Trust, for their pre-tax money. A second account in the name of the plan, XYZ Trust, for their Roth money. And then a third account in the name of the plan for after-tax funds. So that's how you could end up with 3 different accounts. Here we've got an example where there's 2 participants, and each person has pre-tax, Roth, and voluntary after-tax, each set up in the name of the plan. One for the benefit of Jane Doe, a second for the benefit of Jane Doe for Roth money, and then a third for Jane Doe for after-tax, and then another set of 3 for John Doe for pre-tax, Roth, and voluntary after-tax. Here we've got another account set up. Let's say this person's not interested in transferring the money to their Roth Solo 401k. They want to transfer to a Roth IRA. So they might have pre-tax money, right? If they made a pre-tax contribution or they rolled over pre-tax money from a pre-existing account, like a former employer plan or a non-Roth IRA. So that's one account in the name of the plan for their benefit for their pre-tax funds. And then they have a second account in the name of the plan for their benefit for the voluntary after-tax funds. So they can make those voluntary after-tax contributions and then convert out of the plan to a Roth IRA. So it's really just 2 accounts for the plan, and then that third account is their Roth IRA. So that takes us to the end of the slides. Again, we like to highlight that we can continue the conversation on our community site where we're hosting webinars every day of the week. Again, next week, we're going to continue our deep dive contribution discussions with a focus on sole proprietors, 1099 independent contractors, and single member LLCs. Another great venue is our forums where people can post questions 24/7. You can see what other people are asking. Again, you can post your own question. So that's a great, and it's free to join. All are welcome. That's a great feedback. Appreciate that. So we can do a quick one here just to kind of illustrate how to get to it and some basic numbers. So you first go to the website, mysolo401k.net. Under Learn, click on Online Tools. You want to click through to the calculator. Again, you choose unincorporated sole proprietorship. Let's say you've got $100,000 on line 14 of the K-1. And let's say we are 40 years old. Click Calculate, and this is running it for 2021. Then you can click View Report, and you can see here, it's showing you how much you can contribute as an employer contribution, how much can be contributed as an employee, the maximum contribution amount. You can print it to save a copy for your records. So hopefully that helps. And of course, we are fielding questions all the time from our existing customers to go over the specific contribution scenario for them. People are also posting their scenarios in our forums. So we want to help out and help you run these calculations as much as possible. So if you're on the YouTube channel, please like and subscribe. If you're watching as a recording, you can go to our forums. You can post a follow-up question. Please, again, continue to engage and participate. We certainly participate the engagement today. We do have a little bit more time if there's more questions. Doesn't look like we have any more questions. So thank you so much for joining today. All the best, and please continue to participate. Thank you so much.